What's going on, everyone? Travis, the Stock Geek here. I hope you're having a healthy and prosperous year so far. Certainly, it has been a roller coaster in life and in markets for many of us. Now, about 5 months ago, I posted a video here on my YouTube channel about a company called Macerich, ticker symbol MAC. And there in that video, I outlined my investment thesis on the company and why I thought the shares could be really interesting from a risk-reward perspective. But a lot's happened since then. We have 2 quarters of financial reporting since then, and also a new strategic investor in the company, and lots has happened in the retail industry as a whole. So I wanted to take today to update everyone on how I'm thinking about MAC and some of the things that have happened around the company recently. As always, got to give you the disclaimer, none of what you see here in the video is specific financial advice. I don't know your situation, so any trades you make are always committed at your own risk and under your own responsibility. So today I want to talk about, number one, who this new strategic investor in MAC is. And a lot of people have been asking, is MAC a potential buyout target? Is this strategic investor looking to acquire all of MAC at some point? So I want to talk about that. Then I'll get into a review of the Q2 2020 financial results that the company just posted a couple of weeks ago. Then I'll talk about the retail industry as a whole and what's been happening in the retail industry. And I'll finish up with some updates on my projections and valuation of MAC. So let's get into the strategic investor. If you've been following MAC and you follow its SEC filings, you'll note that there was a 13D filed by a company called Passive Investment Trust in early August. And that filing indicated that this passive investment trust entity had acquired 6.8% of Macerich, which was 10.1 million shares at an average price in the $7 to $8 range. So roughly $75 million of capital put into this investment. Now, if you go through the SEC filing, you'll note that Passive Investment Trust is actually managed by another company called MYSC LLC. Now, interestingly enough, MYSC LLC was just incorporated earlier this year in April 2020, and its address that is listed for the company is a residential home in New York. So this LLC appears to be a shell. And frankly, neither Passive Investment Trust nor MYSC LLC is an entity or an established investment firm that any one of us knows about. All the filings here by these entities are specifically related to this MAC investment. So who's behind Passive Investment Trust? First of all, it's worth noting that any company or any investment firm that acquires more than 5% of a U.S. publicly traded company has to file either a 13G or 13D filing, which is why we're getting this 13D filing from Passive Investment Trust. Now, a 13D as opposed to a 13G does indicate that the investment firm could be looking to take an active role in its investment, whether that means pushing for management changes or pushing for a board seat or just getting more involved with some kind of partnership or operations with the company. Now, REITs like MAC also have what are called ownership limits in their corporate charter. And REITs do this so that they can maintain their legal and tax status because the law requires that 5 or fewer investors cannot own more than 50% of a REIT for the REIT to still maintain its legal status. So Macerich, like many other REITs, has a 5% ownership limit for any one investor in its corporate charter. And Goodwin Law has a good write-up on this, on why these limits exist and some of the details behind that if you want to look more into that. But like I said, Macerich has a 5% ownership limit in its corporate charter, and yet we saw that Passive Investment Trust was able to acquire 6.8%, and they've actually gotten a waiver from Macerich, the company, to add up to 9.9% of a stake in Macerich, and it was able to do so because it obtained a waiver of the ownership limit from the company. So, interestingly, the waiver gives us a clue about who is behind Passive Investment Trust. Because if you go to the SEC filing, the waiver is an attachment, and you'll see that if you open up this waiver, there's a heading here on this document. So this document was a Word doc, and you can see there's a word up here, Ashkenazy. And that gives us a clue, I believe, into who is behind Passive Investment Trust. I believe that Ashkenazy is short for Ashkenazy Acquisition, which is a private real estate investment firm based out of New York that holds a large multi-billion-dollar portfolio of retail-focused real estate. And Ashkenazy Acquisition, of course, founded by Ben Ashkenazy, who is a billionaire, very low profile. Let's talk about who this entity or who this company is. So Ashkenazy Acquisition, they actually have a publicly facing website. You can go read about who the principals are and what their strategy is. They claim to have more than 100 buildings valued at around $12 billion. Of course, we don't know the split between equity and debt on those buildings. We don't know how much equity Ashkenazy actually has in all those, but pretty big portfolio. And you can look at the core assets here. They own some pretty marquee retail assets like Faneuil Hall in Boston, Shops at River Center, which is on the Riverwalk in San Antonio, Bayside Marketplace in Miami. They also own some notable hotels like the Plaza Hotel in New York, which is a famous hotel. And, they've got a pretty good concentration on both the West and the East Coast, and specifically a pretty good concentration in the Northeast. So, interesting to note. More background that I think is worth noting on Ashkenazy is that they are primarily focused on private deals, and they have partnered with companies like General Growth Properties and Brookfield, which are public entities, but they try to keep a low profile. They seem to hold properties long term, and they seem to, similar to other REITs, leverage their equity with debt, and they do have debt on a lot of their properties. And unfortunately for them, they're actually facing a lot of the same similar headwinds with their retail assets as MAC is right now. And there was an interesting line of stories out a couple months ago, like Faneuil Hall in Boston, which Ashkenazy owns, was trying to make sure that its tenants were paying rent, but their tenants, because the whole thing was closed and not getting revenue, they didn't want to pay rent. So they had a spat, very similar to the way that Simon and Mac is having to deal with tenants not paying rent earlier in the year. So, facing a lot of the same issues. Interesting to note, though, that they did, amongst all of this, make an investment in publicly traded Mac. So what are Ashkenazy's intentions for Mac? Well, we don't have any real prior precedent from Ashkenazy for this. I don't know of any. I wasn't able to dig up any other public equity market investments by Ashkenazy Acquisitions. We do know that, the ownership limits protect MAC shareholders from Ashkenazy just buying up a bunch of shares in the open market. They can't acquire more than 9.9% of the company. Now, that doesn't mean that Ashkenazy couldn't try to make a hostile bid for all of Macerich. They could try to do that. It would require quite a bit of capital. Today, the market cap of MAC is, I believe the company is undervalued, but it's still over $1 billion. And you're going to have to pay a premium to acquire all the companies. So you're probably needing at least $2 billion of equity to try to make it even a hostile bid for all of Macerich today. I'm not sure if Ashkenazy has that amount of capital. I'd be really surprised if it just has that amount of capital or equity sitting in its coffers, but I could be wrong. The other thing to note is that, they use the word passive investment or passive in the phrase passive investment trust in their filing. Passive doesn't imply takeover intentions. On the other hand, they did file a 13D filing, which is not typically a passive type of filing. I will note, however, that Ben Ashkenazy and Ashkenazy Acquisitions usually has a low profile. Like I said, the only real interview I could find was not from the founder, but from one of the other principals. There was a New York Times interview from about 8 years ago, and that did give me a little bit of background on the company, but there wasn't a lot of detail here. So again, they have a pretty low profile. This is the first time I've seen them do anything publicly. So I would be surprised if they took a really aggressive, hostile bid stance here. But what about a merger? Could they decide to have talks with MAC about merging the two companies? And I think it's definitely possible. I think it would be an interesting transaction. I'm not so sure, though, that MAC would want Ashkenazy's full portfolio. And let me tell you why that is. If we look at the core assets, MAC already has pretty good concentration on both the West and the East Coast. What I think would help MAC's portfolio in terms of diversification is adding properties in places like Texas or Colorado, perhaps. But Ashkenazy, although it does have the San Antonio property, doesn't have a lot of concentration there. It has a lot of concentration where MAC already has a lot of concentration. The other thing that Ashkenazy owns is hotels, and MAC has not historically been in the business of owning hotels. MAC has always been pretty focused on retail specifically. So it would be surprising to me to see MAC go after hotel assets, even though those would diversify the portfolio somewhat. Hotels are also facing a lot of the same headwinds as retail properties right now, given the lack of ability to travel internationally for many countries. So worth keeping in mind, too, that hotels are also hurting. So it's not like that would be a boon to MAC's portfolio in the current retail environment. So my conclusion on the strategic investor is that I think this is just a savvy move by Ashkenazy to deploy $75 million of capital in a really undervalued real estate company. And it just so happens to be public, and it's MAC equity. And, it could be an opportunity to develop a deeper relationship for future partnership deals that these two companies may want to partner on. But I don't necessarily think that Ashkenazy is about to try to buy out all of MAC. Again, I could be 100% wrong about this, but that's just my read, kind of taking in all of the pieces of information I have right now, and that could change. But certainly a very, very positive thing, I think, overall, to have an industry insider who really agrees with us that MAC is super undervalued, and instead of buying more properties themselves, they went and bought MAC equity. So I think that's a pretty strong positive overall, even if it doesn't end up leading to an acquisition offer. And lastly, on this point, I just wanted to give credit where credit is due, because the first person that really helped uncover this mystery here was actually a StockTwits user, Limo360, who was the first person I saw online to kind of internet sleuth this out and see that heading in the attachment. And that word Ashkenazy was enough to kind of get us on the right track as far as figuring out who was truly behind the passive investment trust. So let's talk about MAC's Q2 2020 financials that it just recently reported at the beginning of August. Now, MAC's calendar Q2 includes the months of April, May, and June. And we know that a lot of MAC shopping centers were closed in the months of April and May, and even some of its shopping centers were closed for the entire quarter. So we knew that the financials were going to look pretty grim going into this report. And certainly they were. We saw that revenue was down 22% year over year. Same center net operating income was down 23% year over year, and adjusted funds from operations, or AFFO, which is a proxy metric for the amount of cash flow the company generates that can be paid out to shareholders, that was down 55% year over year. And in fact, it was the worst quarter ever for MAC in terms of an AFFO drop. For reference, even in the 2008-2009 financial crisis and recession, AFFO dropped about 30% from peak to trough for MAC. So this was a truly historically bad quarter for MAC. Now, worth noting as well that cash rent collections were even worse than the drop in revenue. And how can that be? Well, revenue includes accruals, which is really estimates from management about the ultimate amount of rent that can be collected. And management does expect eventually to collect about 76% of Q2 rent based on its current estimates and negotiations with retailers. But through the August report, they had only collected about 40% of April and May rent from its tenants and about 58% of its rent in June from its tenants. They do expect to recover a lot of the back rent later this year and early next year, which they've worked out with a number of their tenants. And it was good to see the improvement in rent collection from April to June. And we've continued to see an improvement in rent collections in July and August, with MAC collecting about 66% of its contracted July rents, and it had already collected about 51% of its August rents just through the first week of August, which was ahead of July's pace. So August should end higher than July. And hopefully by September timeframe, they're collecting 70 or 80 or 90% of contracted rent and improving thereafter. So again, important to note that cash rent collection improving, wasn't great in Q2. Do expect that to at least get somewhat dealt with by the end of this year, and we'll end up with a revenue number or a cash rent collection number that matches the revenue decline a little closer. When it comes to occupancy, obviously not great either. Management expects to lose about 2% of its occupancy this year due to retailer bankruptcies. And I think we're already seeing the flow through to that, because we saw occupancy rate in the second quarter at about 91.3% on average for MAC's portfolio. For reference, in 2008 and 2009, occupancy dropped to about 90% at the bottom of the recession for MAC. And I think this time we're probably headed a little bit lower at the trough anyway this time potentially. We could end up at 88 or 89% occupancy levels on average for MAC by the end of the year as more retailers exit some of the space they think they don't need. But again, MAC does have a really great property, so it's possible it won't get to that level. But we are seeing a drop in occupancy rate, at least in the near term, even though MAC hopes to eventually fill some of that occupancy space with new tenants. So let's talk about some of the conference call comments that management made that I think are really helpful for understanding where the business has been and where it's headed. Of course, management said that sales and occupancy are improving week by week, which is great to see. Management also said that they think that 2020 will be the financial trough for the company. And that is really important because I am forecasting 2021 to be an improvement over 2020 and then continuing through 2022 and 2023. So good to see that management also agrees with that. And like I mentioned, they said that about 2% occupancy loss from bankruptcies, and I'm going to talk more about retailer bankruptcies here in a few minutes. But management also said that they don't anticipate similar volume of bankruptcy filings going forward. So that's really interesting, and I'm going to dig into that as well here shortly. Now, they said for centers opened at least 8 weeks, sales were already up to about 90% of pre-COVID levels. So that's showing that the recovery for the brick and mortar retailers has actually been pretty swift once the shopping centers open. And that's very, very important for overall retailer health and for Mac's business as a whole. You know, there were people out there saying that sales were completely gone for brick and mortar retailers forever and they'd forever shifted online, but that's really not showing out in some of the sales numbers, at least for centers that had reopened for a couple of months. Also, management said that they expect to be in a positive cash flow position for the balance of the year. In Q2, we did see cash flow from operations for Mac go negative, and that was the first time we'd seen that in a long time from Mac. So it's good to note that they expect to be in positive cash flow position probably for Q3 and Q4. And management also said, one of the more interesting quotes, that the CEO said, it certainly isn't the right time to raise equity with the stock trading around $8 a share. So CEO Tom O'Hearn, I agree with him. I think it would be a horrible idea for them to raise capital at such an undervalued share price. It would create a ton of unnecessary dilution, and they obviously think the stock is undervalued. And actually, as I make this video, the stock is trading closer to $7 per share. So certainly, if they thought it was undervalued at $8 in August, I would imagine that they think it's even more undervalued here today. So that brings us to the topic of mortgage debt refinancing. Mac has 5 properties that have mortgage loans which are due to mature in the next year or so. That includes Danbury Fair, Fashion Outlets of Niagara, Flatiron Crossing, Green Acres Mall, and the shops at Atlas Park. Now, you'll note that these are not Tier 1 or Tier 2 assets, which is great because that means Mac isn't being forced to refinance or extend loans on its marquee properties during the worst retail environment in a decade. So these are assets obviously that Mac wants to keep. You know, they have pretty good metrics. You can see here most of them pre-COVID had occupancy above 93% with sales per square foot well above $600 for its underlying retailers. So these are pretty good metrics. Management also said on average these properties were currently leveraged less than 40%. I estimate these 5 properties represent about 10% of NOI in total, maybe 8 to 10% or so. And the CFO said, although they're probably not going to get refinancings of these loans done in the near term, they do expect to extend these loans and get short-term extensions, just as they did with some of their properties in 2008 and 2009. And he doesn't expect there to be any significant changes in the economics of those loans. I will note, Danbury and Fashion Outlets of Niagara have their loans maturing here very shortly in October of 2020. So we're really towing the line here with these maturities. And it's possible if they don't get them done that Mac is going to have to hand over the keys to these properties to the lenders. But I hope that doesn't happen. And I'm waiting literally any day for the press release to drop that they've gotten these loans extended in the short term. And I estimate Danbury has around a $100 to $150 million equity cushion, depending on your cap rate or asset value assumptions. Now, Danbury could be around 2 to 3% of NOI, so if they lose it, it's not going to be the end of the world, but it's not ideal. So I'm really hoping to see them announce something about a loan extension on Danbury and Fashion Outlets very, very soon. With the other properties, Flatiron, Green Acres, and Atlas, they have a little bit more time. Those mature in early to mid 2021. That also brings us to the topic of the credit facility refinancing. So Mac also has a $1.5 billion line of credit, and that matures in July of 2021. Now, that isn't secured by properties the way that the other mortgage loans are, but it is sitting at the parent company level, and so it is very, very relevant for us equity holders. It also does have financial covenants. So we'd really like to see Mac deal with this sooner rather than later. But one lever that Mac could pull to get this refinanced or to get a new loan in place for this is to actually use some of its unsecured properties, which I noted in the first video have about a book value of probably in the $1.4 to $1.5 billion range. They could potentially use those properties as collateral for a new credit facility or a new line of credit. Wouldn't be the most ideal thing to have to put those properties up as collateral, but it is a possible lever, like I mentioned. Management comments about the credit facility refinancing talks was that it's obviously a big point of focus for them, and the CFO said that he feels good about that, about how the talks are going. Important to note, too, that there's a number of different lenders on this line of credit. It's actually spread across a number of banks, including Deutsche Bank, JP Morgan, Wells Fargo, US Bank, and Goldman Sachs. and a number of others as well that you can see here. But that means that no one bank is overly exposed to this loan, and hopefully not one bank decision can actually kill the ability to get this refinancing done. So that could be helpful as well. Now, other notes from the conference call and the quarter include the fact that, I think I mentioned this earlier, but MAC has commitments for leases on 87% of the expiring square footage in 2020. So they have a lot of great tenants like Restoration Hardware and Tesla and Warby Parker and West Elm filling a lot of the empty space that's coming up from some of their current lease expirations. So good to see that. Obviously, bankruptcies are going to add some more square footage to that they're going to have to deal with. But in time, hopefully, they'll be able to fill up all that space, especially in some of their higher tier, higher quality properties. Also important to note that some of MAC's properties have been closed even all summer. It had two New York properties, two big properties, including the Queens Center and Kings Plaza, that actually just reopened here in September. And MAC put out a press release on that, and they actually had lots of shoppers in line ahead of those reopenings, which is great to see. MAC also had some indoor centers in California, which got closed over the summer due to second waves, and those properties should hopefully be open very, very soon as well. So that's really important, and that should help the financials going forward as well. Now, MAC has been really doing a good job with cash management by deferring things like CapEx, which they're cutting down by $90 million this year relative to their original plan. So that will save them a little bit of capital that they were planning to spend on some developments of existing properties. And then they also deferred, this was great to see, they deferred $47 million of debt service payments that were due on Q2 and Q3 mortgage payments, and they deferred that into Q4 and into Q1 next year with their lenders. So it shows, one, that they could get a little bit of relief from a cash flow perspective, but two, that they have good relations with their lenders, and their lenders are working with them to give them some breathing room, because obviously MAC's tenants aren't paying them. So having the ability to defer debt service payments is really helpful for MAC also. Now, MAC did note that they will be hopefully getting very shortly $45 million of proceeds from the Tyson's apartment tower, which they're doing a financing on, and are in late stage talks on that. So that would also free up some capital for whatever MAC needs it for in the near term as well. So let's talk dividends. In Q1, we saw a massive cut in the dividend because MAC was entering into uncharted territory with shutdowns, and so they smartly cut the dividend down from a 75-cent cash dividend in the prior quarter to about 10 cents of cash dividend per share. We also got a stock dividend in Q1, and that was needed because in Q1, MAC still reported a pretty high cash flow per share, and instead of paying that all out in cash, they wanted to preserve some of that cash, so they actually gave part of that with a stock dividend. Now in Q2, they didn't have quite the level of cash flow in their financial statements, so they were able to actually just pay the cash dividend and not pay a stock dividend. And in fact, they actually raised the cash dividend in Q2 by about 5 cents a share to 15 cents per share. So that was nice to see, actually. And at this current rate, if MAC's financials continue to improve, that will allow them to actually retain some excess cash flow if they were to keep the dividend at 15 cents per share for the next few quarters. I'm hoping overall that, maybe not next quarter, but in a few quarters, the dividend will start to recover and we'll start to see a higher dividend per share once MAC's rent collections and cash flows overall improve. But even at today's levels, with the 15 cent per share cash dividend, the current dividend yield on the stock is about 8% annually, which is pretty good when you compare it to a lot of the other alternative low interest rates out there. And I think the cash dividends should slowly recover as FFO recovers over the coming quarters and years. Now let's talk about some of the recent developments and dynamics affecting MAC and its retail industry peers. There's been a huge uptick in retailers filing for bankruptcy this year, with storied brands like J.Crew, Brooks Brothers, JCPenney, Neiman Marcus, Lord & Taylor, and Men's Warehouse all filing for bankruptcy this year. There's a great list on RetailDive.com if you want to see the retailers that have filed for bankruptcy so far in 2020. But frankly, most of these bankruptcies were not a surprise. If you look at the stock prices of these bankrupt retailers prior to 2020 and prior to the coronavirus crisis, you'll see many of them were already down 70 to 80%. And so these were already troubled businesses that were teetering on the edge. The same could be said of the privately held retailers J. Crew and Neiman Marcus, where we have Wall Street Journal headlines from early 2019 indicating these businesses were looking to restructure because they had too much debt on their balance sheets. Now, COVID was an acceleration event for many of these bankruptcies, and COVID has also accelerated the shift from brick and mortar retail spending to online retail spending, which is pretty obvious. If stores are closed, then people are going to look to fulfill orders online. But how permanently all of this consumer spending shift will be is still an open question once we have brick and mortar stores open more broadly. It's also important to note that omnichannel retailers, the ones that have both brick and mortar and online stores, have told us that the online sales are less profitable because of higher shipping costs and higher customer acquisition costs online. So most omnichannel retailers will want a very healthy brick and mortar retail channel. Now, some good news here is that many of these bankrupt retailers are not liquidating, meaning they will restructure and reemerge with a smaller but more profitable store footprint. So here I've listed the mall-based retailers that have filed for bankruptcy this year, and the ones in red are the ones that are liquidating and actually selling all of their merchandise and closing all their stores, but the ones in green and yellow are the retailers that will actually restructure and come out of bankruptcy with a good number of their stores intact. So you can see here Brooks Brothers, J. Crew, JCPenney, Neiman Marcus, Taylor Brands, those will all be at least partially reorganizing and reemerging with a decent-sized store footprint. And of the retailers who haven't filed for bankruptcy, they've staged a pretty great comeback so far this year in terms of share prices. So if we look at retailers like Foot Locker, L Brands, Dick's Sporting Goods, American Eagle, Urban Outfitters, Lululemon, you can see that although they sold off pretty dramatically during the initial coronavirus crisis, they've all recovered quite nicely from that bottom. And in fact, many of these retailers are not only up in share price, but they're actually seeing increases in their overall sales trends. So the outlier here is MAC, which is really strange to see. MAC is really not recovering, although its retailer tenants are recovering. And the reports from those retailers recently do indicate a continued recovery in their trading and in their sales performance. Now, when we look at MAC's top tenants by rent from their 2019 annual report, you can see their top 10 tenants here, and a lot of those were the ones that I just showed you on that chart, which have seen quite a nice increase in their stock prices in recent months. In fact, when I look at the market cap of these businesses, the average equity value of these companies is now around $6.5 billion. So you've got quite a few on MAC's top 10 list that are multi-billion-dollar companies, at least as valued by the market today. The one exception is Express, which is at the bottom here and really has not recovered in terms of its market value. Now, Express is at the very bottom of MAC's top 10 tenant list, so it wouldn't be the end of the world if they do lose some Express stores eventually, but that is one to keep on the watch list. And I do keep a watch list of retailers here. Like Max said in its conference call, there's not as many as there were last year on the watch list, frankly. The ones that I would be watching would be companies like Express, Chico's. You've got a few others here that seem to be doing fine. AMC would obviously be a candidate if theaters can't reopen for a long while, and most of these are in pretty decent shape for now. So worth noting that. Now, Max still does have pretty significant department store exposure overall. I've compiled the department store exposure by department store for all of Max properties. You can see that here. And the interesting thing to note is that Mac, although it does have significant JCPenney and Macy's exposure, will not actually be losing very many of those stores. We can actually look up JCPenney's announced store closings and see that Mac only has 2 stores in Kings Plaza and in Green Acres Mall, where they will be losing a JCPenney's. So at least currently, it looks like when JCPenney's reemerges from their restructuring, a lot of the stores that JCPenney's has in Mac malls will reopen. And that just speaks, I think, to the quality of a lot of Mac's properties and the fact that the JCPenney's in those properties must be doing decently well and turning a profit. Same is true of Macy's, which announced 125 store closures at the beginning of this year, and I believe Mac had either 0 or just 1 of those stores in its store base. So very nice to see that. Now, Mac will have to replace just a couple of Lord & Taylor stores at a few of its properties, but again, with a property like Tyson's Corner, probably a place where they'll be able to replace that space with some pretty healthy new tenants. And Nordstrom, of course, is a department store that I believe will have the ability to go the distance in terms of surviving, and they don't seem to be in any kind of major distress at the moment. They also tend to be in some of the higher quality properties at MAC, so I don't worry about them too much. Now let's talk about the Simon and the Taubman deal, which has been in the news. So Simon Property, which is MAC's larger competitor, obviously they went and did a bid for Taubman right before the coronavirus hit, and Simon wants to back out of that deal because it was poorly timed and they probably want to keep that capital. Now, Taubman does want that deal to go through, so this could go to trial later this year. And right now, Taubman's stock is trading with about a 50% probability that the deal goes through. So really unclear how this all will end. But again, I don't think it will affect MAC too directly, but it is something to keep an eye on, something that I'm watching. And if the deal is called off, it does pose the question of whether MAC and Taubman would consider some kind of a merger or partnership where there might be some synergies they could pull out and take on the big bad Simon, who has really tarnished their reputation at this point. One development that does affect MAC directly is the large increase in short interest in MAC stock. So there's been a huge uptick in the number of shares sold short with MAC, and now about 51% of all of MAC's outstanding shares are sold short, meaning there are short sellers betting against MAC and who believe the stock will decline from here. So this has become a very highly shorted stock at this point, with 51% of the outstanding shares sold short. And a lot of people have asked me, well, what do these short sellers know that we don't? What's the thesis? And frankly, I have talked to a number of institutional and individual investors, some of whom are bearish on the retail industry. I have not found a new piece of information that I thought was significant that changed my thesis on the recovery in MAC. I have read the broker report where there was a downgrade from Morgan Stanley recently. Frankly, I didn't think that was particularly insightful, and they were using a debt ratio that was based on market levels of equity versus debt. So I think that's just an incorrect way to look at leverage ratios. And frankly, this was more a report on Kimco than it was on MAC. And so I didn't really think there was a whole lot there in terms of substance. But nonetheless, it is worth noting the increase in short interest. It will possibly become a tailwind if MAC does continue to recover in terms of its not only financial performance, but share price performance in the quarters and years ahead. Then a lot of these shorts could actually become buyers as they need to cover their short positions. So again, the short sellers could end up actually creating a tailwind for holders of MAC stock at some point. Finally, let's look at some updated projections and valuation of what I think MAC might be worth in the coming years. If you watched my previous video, you'll note that my previous estimates were pretty bad, and MAC was going to suffer potentially up to like a 30% revenue decline for the year and an AFFO decline of around 75%. And that was based on different components such as the lost rent from retailers during the shutdown period, as well as a big hit to variable rent revenue, which MAC gets on some of its lease contracts where it actually gets a percentage of the retailer's underlying sales. And with retailers hurting and losing a lot of sales this year, that obviously will take a hit. Then also, I was working in retailer bankruptcy and retailer lease renegotiation impacts into that as well. But we've just come off the Q2 quarter, which I think could be one of the worst quarters, if not the worst quarter in MAC history. And already we're seeing some improvement from that, according to MAC management. So we had FFO declining about 55% and revenue only declining about 22%. So my projections do look a little bit too aggressive in terms of my previous projections. Also, it's worth noting that in terms of the calendar, MAC's Q1 was relatively unaffected. So for the full year, you're only going to have 3 affected quarters. So my current estimates currently now reflect revenue declining about 20% for 2020. And I actually did reduce the amount of operating expenses that they're cutting because Q2 showed about a 10% decline in shopping center operating expenses. But I think as more and more centers open throughout the year, those declines should moderate a bit. And then, of course, you do have some increases in REIT G&A expenses offsetting that. And ultimately, I'm getting down to an FFO for 2020 that is still a decline of more than 50% versus the prior year. So I feel like I'm being pretty conservative with these estimates. I do, however, expect improvement in 2021 and 2022, as hopefully MAC will not have any periods of rent income loss And then hopefully variable rent components will improve, as well as things like parking lot revenue. And hopefully MAC can also get some positive impacts from releasing some of the empty space that's left from bankrupt retailers and retailers who are needing to give up space in some of MAC's less quality properties. So that's really the overall view of things. And again, it really depends on what you think they can produce in terms of FFO, but also the multiple that you're willing to give that will get you to a target stock price. And I think, a reasonable AFFO multiple is certainly what I have here in the 10-12 range in my base case. And I think you could argue for an even higher AFFO multiple given MAC's historical range, as well as the really low interest rates, which do argue for higher multiples for stocks in the current environment. So using relatively conservative assumptions and what I think are very reasonable multiples, I'm still getting to a potential stock price in my base case for MAC in the $20+ range. We're trading under 7 today, so that would be quite the return. If we look at the sensitivity table using AFFO and AFFO multiples, you can see what the stock price might look like under different assumptions. Again, about $300 million of adjusted FFO for 2022 is what I'm expecting in my base case, and I could be even being a little bit too conservative here. So I think a $20 to $30 stock price is very achievable, and you could even argue potentially for higher numbers if AFFO is better than expected or if you give it a higher multiple. Of course, the opposite is true too. If you think retail apocalypse is here and there's going to be a mass exodus of retailers leaving malls next year and the year after and the year after that, then certainly you would probably be over here in this quadrant, and you might argue that MAC stock is fairly valued. Now, some final notes from me. People have asked me, am I still bullish? Do I still own the stock? And I say, yes, of course I do. My base case suggests that MAC stock can triple within about 18 to 24 months. Of course, there's no guarantee on that, but I do believe that this is a very high reward level, and you don't find a lot of no-brainers like this where you can see very clear upside without making a whole lot of long-term crazy assumptions. And I also want to note that MAC is still trading at a significant discount to its larger peer, Simon Property Group, ticker symbol SPG, and MAC has certainly declined much more than Simon over the past 3 years, and I believe Simon currently trades at an FFO multiple that's almost twice of MAC's today. So worth noting that. And of course, retail is still in a very major transition phase. There's still a lot of puts and takes, still a lot of unknowns about how many stores retailers need to give up. But again, MAC does have some really nice quality properties that I think will do well. And you've even got some newer properties like Fashion District Philadelphia, which are still ramping up, and I think will help support MAC's recovery going forward. So some things that I'll be watching in the next few months will be the refinancings of the mortgage debt and the credit facility. Those are going to be super key, and it'll really give us some insight into how lenders are thinking about the business and MAC's ability to get extensions on loans in a tough environment. And of course, some of those deadlines are getting closer, so I'll be watching that very closely in the coming weeks. I'll also be watching how physical retail sales continue to evolve over the rest of the year, because it's going to be very important for the health of brick and mortar retailers to see physical retail continue to recover and shoppers continue to return to stores. Now, this investment is not the hottest momentum tech stock out there, so I always say patience is key with something like this. This is more of a value type investment, more of a contrarian play. So it could be 2021 or 2022 before we see the bulk of what I think the return will be in the stock. Hopefully it happens sooner than that. But again, this is one where we may not see the entire return happen in just a few months. We may have to wait as things actually do recover over the coming quarters and years. So that's it from me. If you have any more questions on MAC, feel free to hit me in the comments. And cheers, everyone.